So we've talked about the benefits of pensions in terms of tax benefits and also the rule changes. But Ben, just turning to you, in terms of the monies that you've built up in a pension, from the point of view of passing on wealth, what typically happens on death to your pension?
Okay, well, there's a lot of flexibility in the rules to allow pensions to be passed on death. Not all pensions can be passed on death. It does depend on the type of arrangement, but keeping it simple for this session, personal pensions can be left to beneficiaries on death, and it's the full value of the pension that can be passed on. So this leads to kind of opportunities for planning to use the pension vehicle as a way of storing wealth and passing it on to loved ones free of inheritance tax. Now, the situation on death before 75 is that the full value of a pension pot can be left to beneficiaries free of tax. That's completely free of tax, free of income tax and inheritance tax. And an individual can choose to nominate beneficiaries, specific individuals they want to receive their pension benefits on death, or a charity or a trust. So there's lots of flexibility to control how pensions are used on death. Now, the position is slightly different should the individual pension member pass away after age 75. In this instance, the value of the pension can still be left to their nominated beneficiaries free of inheritance tax, but if they've nominated individuals to receive the pension, those individual beneficiaries will be subject to income tax should they draw from their inherited pension. Now, they don't have to draw from the pension immediately. They could choose, if they wanted, to retain the pension wrapper and choose to defer drawing on it for a period until perhaps they reach retirement, and they will be able to use their inherited pension as an income source in retirement. And could be that at that point they're not a higher rate taxpayer and would pay basic rate tax to draw on the pension. And in the interim period, the inherited pension wrapper will allow them to accrue investment growth tax-free. So an inherited pension is a particularly attractive way of passing on wealth through generations.
It sounds very tax efficient. And interesting on the inheritance tax point, because obviously that wasn't always the case. It's certainly become more flexible. But on that point, Neil, does that apply to all pensions? So there's no inheritance tax whatsoever as far as any individual is concerned?
So generally speaking, inheritance tax is not a consideration when there's pension contributions or benefits, and that's why they can be used very effectively as an estate planning tool. However, there are some instances where you do have to think about inheritance tax, so it's not quite as simple. So, for instance, in respect of pension contributions, if these are made by a member who is in ill health, then he or she could be considered to have a transfer of value for inheritance tax purposes, and HMRC particularly scrutinise any pension contributions within the 2 years prior to a member's death. In respect of pension benefits themselves, there are certain scenarios again that could attract inheritance tax. So retirement annuity contracts are one of them, where there is a legal right to a payment to go into a deceased member's pension fund, or a transfer of value of a pension between two providers. That can also cause inheritance tax as well, particularly where, again, the member is in ill health. So generally, yes, inheritance tax is not a consideration for pensions, but there are a couple of scenarios where it is, and so you do need to take a bit of care and also a bit of planning as well.
Okay. And as you know, Trevor, obviously we have a lot of clients that have a US connection here in the UK, and we've talked before about how the tax relief might work. So presumably on the inheritance tax side, it's all very straightforward and the US isn't interested.
No such luck, Rachel, I'm afraid to say. These are UK plans, so they're non-US plans. Therefore, the US will tax them. Yeah. So the value of the plan will be included within the individual's worldwide estate at death, and therefore potentially be liable to US estate tax. That's the bad news. The more encouraging news is that currently the US estate exemption is some $13 million. So a significant amount of money here. So basically, if a person's combined estate, including the pension, is less than $13 million, and they've not eaten into that exemption during their lifetime, well then there'll be no net US estate tax to pay. Now, one word of caution, $13 million is the current amount. That is scheduled to half in 2026.
Okay. So obviously we've talked about how we can pass on wealth through a pension tax efficiently, and with your caveats as well, Trevor, in terms of US citizens. Are there any other planning opportunities, Ben, using pensions specifically, where people can pass on wealth if they wish to?
Yes, Richard, I think there are a number of planning opportunities for the use of pensions as an estate planning tool. Obviously, pensions, as we've identified today, offer tax-efficient investment opportunities, and there can be no inheritance tax on pensions on death. So one potential opportunity for the use of a pension as an estate planning vehicle would be to, for an individual, let's say, who reaches retirement with a pension and other assets. So if we're saying the pension is free of inheritance tax, the other assets in their estate could be possibly subject to a future inheritance tax charge. And if they wanted, they could decide to defer drawing on their pension in retirement and instead draw on the assets in their estate, whether that be ISAs, taxable investments, or perhaps rental property. And the net effect of this would be the pension is left to grow, and this will maximise the value of the pension in the long run. And they'll be drawing income from their taxable estate, which will suppress the value of that and could even lead to a drawdown in value over time, which will reduce the ultimate inheritance tax liability on death.
It's an interesting point, isn't it? Because people often, I think, certainly with our clients, they start off often thinking pensions are the default, where you start drawing income from first, rather than necessarily just seeing them as another asset, really.
Yeah, quite. And I think that's the key thing, is that pensions are ultimately a tax wrapper. And the way you invest in a pension, it obviously depends on the individual, but there's lots of flexibility now to invest. And if you're taking a long-term view, the pension isn't necessarily there just to provide income. And another planning opportunity available for the use of a pension would be to try to maximise contributions to a pension in your lifetime, or possibly even to make contributions for family members. So pension contributions aren't limited to earned income, and therefore pension contributions don't have to stop at retirement, so you can carry on paying into your pension in retirement. Contributions are limited where there's no earned income to £3,600, but the £3,600 contribution will receive basic rate tax relief, 20%. So it would only cost an individual £2,880 to pay into the pension, so they're receiving £720 of tax relief on that contribution, and wealth's being moved into the pension wrapper where it's free of inheritance tax. Now that option is available for the individual to pay into their pension, but they could also pay into family members' pensions, perhaps a spouse or partner or children or grandchildren, and the same allowance is possibly available if the potential beneficiary isn't already using their allowance. So that obviously offers opportunity to store wealth or to pass on wealth through gifting into family members' pensions. Now, one important consideration if considering gifting into a family member's pension is that the beneficiary of the gift won't be able to access the benefits within their pension until they reach age 55 under current rules, which could be a long time period for younger beneficiaries. Another limiting factor in the past has been the lifetime allowance, and any contributions to children or grandchildren, maybe in their 20s or 30s, would have had a number of years of investment growth. And it could have been that the growth and the value of the extra contributions from family members, as well as the value of the contributions themselves, could have meant that the individual child or grandchild would have breached their lifetime allowance at some point in future. Now, the recent rule changes to the lifetime allowance could remove this issue, but it is still an important consideration, I think, for the longer term.
Yeah, that's a good point, Ben, because this makes family contributions a possibility again, and particularly for those parents who perhaps have children who've reached working age and have a salary, where they're not restricted to the 3,600 gross contributions. So if we take an example of a parent whose child has reached working age and is earning £50,000 a year, now understandably that child might not have the level of available income to utilise their annual allowances for pension purposes, because they've got other costs to meet, such as rent or general living expenses or saving for a property. Now, if they were to contribute, say, £5,000 along with their employer into the pension, there'd be £45,000 of unused allowances, and therefore capacity for a parent to make a contribution on behalf of that child. Okay, so if they were to do that, they could make the net contribution, and then HMRC would pay the tax relief directly into the child's pension fund. that would be the basic rate tax relief. So if the child is a higher or additional rate payer, you could potentially get higher rates of relief of 40 and 45%. Now, one thing to consider when you are contributing to somebody else's pension fund, of course, is inheritance tax. So generally, large pension payments into a contribution to somebody else's pension will result in a potentially exempt transfer for inheritance tax. Now, what that means is the person who made the contribution must survive 7 years from the date of the contribution in order for it to be free from inheritance tax. For smaller pension payments, there are reliefs and exemptions that might make them exempt from inheritance tax immediately, or there is a valuable exemption if the parent is to make the contribution from excess income. So that could potentially mean that the payment into the child's pension fund is free from inheritance tax with immediate effect.
That's an interesting point, Neil, when you're saying it in terms of the regular income. So just to run through that and see what it looks like in terms of the tax relief and the cost. If we were to look at, say, an individual where the parent is paying in, say, £1,000 a month into the child's pension, can you run through what the tax relief looks like from the overall family perspective?
Yeah, definitely. So if you take your example of £1,000 per month, that's £12,000 per annum. Now, the first step would be that once the £12,000 net contribution is made, HMRC paying the £3,000 of basic rate tax relief directly into the child's pension fund. Mm-hmm. And now, assuming that the parent benefits from the surplus income exemption for inheritance tax, that's also a £4,800 inheritance tax saving. Now, what this effectively means is there is a rate of tax relief across the family of 65% for a basic rate taxpayer. Now, if the child is a higher or additional rate taxpayer, you can get higher rates of relief of up to 90 and 96.25% respectively, so very high rates of tax relief.
So it can be very tax efficient, particularly, as you say, if the child has relevant earnings as well.
Yeah, exactly, and that's the key, that the child in this case has relevant earnings, and so this opportunity is available to the family.
And I think one of the key considerations for use of pensions by a family is not just making the contributions, but also how to invest within the pension wrapper, and where you've got multiple parties to that decision, thinking about how to invest is perhaps more difficult, but also it's still important. And over the long term, investment growth will increase the value of wealth stored in the pension and can further improve the benefits to children and grandchildren.